Hey everyone, and welcome to This Explainer. If you've been looking at the housing market lately, well, you already know it feels like a total maze of contradictory headlines, right? So today we're going to cut straight through all that noise. We are setting the stage in late August of 2026, and we're looking directly at the hard real estate data. We're pulling numbers straight from Freddie Mac, the FHFA, and the Federal Reserve to figure out exactly what is actually going on out there.
Is it a good time to buy a house? This is, without a doubt, the single most searched real estate question in the United States. And honestly, it has been for years. And that makes total sense. We absolutely acknowledge the anxiety you might be feeling when contemplating what is probably the single biggest financial decision of your life. Everyone wants to time the market perfectly, don't they? But finding the real answer means looking past the broad anxiety and focusing in on the actual objective numbers.
Okay, let's dive into this roadmap to demystify all this. First, we'll tackle the big housing question. Second, we'll look at where mortgage rates currently stand. Third, the historical rate reality. Fourth, prices and inventory today. And finally, number 5, the affordability math.
Section 1. The big housing question.
I really want to emphasize this right up front. The answer to whether it's a good time to buy depends much less on the calendar year and far, far more on your individual numbers. The market matters, absolutely. But your personal math matters way more. Yes, we are going to look closely at the national data and the overall macroeconomy, but your ultimate decision, it shouldn't be about chasing market headlines or waiting for some hypothetical perfect moment. It relies entirely on your personal financial reality. So let's look at exactly what that reality is built on right now. Section 2. Where mortgage rates stand. Let's get into the hard numbers for late August 2026. According to Freddie Mac's primary mortgage market survey for the week ending August 20th, the average 30-year fixed mortgage rate is sitting right at 6.65%. Now, what's kind of fascinating here is that exactly 12 months ago, in August 2025, that same rate was 6.58%. So despite all the anticipation of big rate cuts, rates today are actually a touch higher than they were a year ago. Looking down the data, you can see the 15-year fixed rate is averaging 5.95%. FHA-backed loans are around 6.38%, and VA loans are at 6.49%. Those are both slightly cheaper than conventional financing simply because that government guarantee reduces the lender's risk.
And this brilliantly illustrates what those percentages actually mean in real dollars. Let's say you take out a $300,000 mortgage at roughly 6.66%. Over a 30-year term, you're going to pay approximately $394,000 just in interest. That is a shocking reality. You end up paying more in interest than the original loan amount itself. But if you switch to a 15-year term in that exact same rate environment, your total interest bill drops dramatically to about $150,000. Now, obviously, your monthly payment will be considerably higher, but the long-term savings, they're absolutely massive.
It really helps to look at the journey these rates have taken over the year. Back in February of 2026, rates actually dipped down to 5.98%. But, they didn't stay there. Persistent inflation worries and heavy Treasury issuance pushed yields right back up. By July, the Federal Reserve decided to hold their benchmark rate steady at 3.50 to 3.75%. Actually, a few committee members even voted for a rate increase, which tells us that inflation concerns definitely haven't fully faded. Looking ahead to the end of the year, Fannie Mae projects rates will just kind of hover around 6.4%. So, basically, we're looking at a modest improvement, definitely not a dramatic drop.
So, why is this happening? Well, mortgage rates don't just move in a vacuum. They closely track the 10-year Treasury yield, which as of late August was yielding 4.74%. Lenders typically add a risk premium, often called a spread, on top of that Treasury yield. Now, historically, that normal spread is about 1.5 percentage points. But right now, the spread is a much wider 1.91 points. That wider than usual premium directly reflects some ongoing uncertainty in the bond market. Lenders are basically padding their margins because they simply aren't totally sure where the wider economy is headed next.
Section 3. The historical rate reality.
All right, let's zoom out and bust some major myths about what a normal interest rate actually looks like, because recency bias is seriously confusing a lot of potential homebuyers right now. The pandemic low of 2.66% was an extreme outlier. I mean, literally the lowest 30-year rate ever recorded by Freddie Mac. Today, we have our current rate of 6.65%, but look at the long-run historical average for a 30-year fixed mortgage, it's actually close to 8%. This completely shatters the illusion that 3% is normal. Today's rates are, believe it or not, actually lower than the 8% long-run historical average.
So the absolute crucial point to take away is this: rates below 4% were a historical anomaly, not the benchmark. Those extremely low rates we saw, mainly between 2016 and the pandemic years, they unrealistically reset everyone's expectations. Today's rates might feel super high compared to 2021, but they are not historically extreme. They're simply a return to something much closer to the true historical norm.
Section 4. Prices and inventory today.
As any financial advisor will tell you, interest rates are only half of the affordability equation. The other half is what the homes actually cost and how many of them are even available to buy. And here is some genuinely good news for buyers. 15%. Multiple reports from 2026 note that housing inventory has improved meaningfully, with one analysis citing that inventory is up more than 15% year over year. More sellers are finally listing their homes, and new construction is adding real supply to the market. This is a real game changer because it means we're moving away from those incredibly tight, intense bidding war conditions that defined the market just a couple of years ago.
But what about home prices? Well, according to the Federal Housing Finance Agency, home prices have risen at a steady, sustainable 2.2% year-over-year pace. And this constant, modest growth is exactly why the national conforming loan limits had to be raised. For 2026, the limit went up to $832,750, which is up from $806,500 the year prior. Because these limits move in lockstep with home price data, this rising limit is itself a signal that prices nationally are still climbing, just at a much more moderate pace than the crazy boom we saw earlier this decade.
This brings us to a phrase you've probably heard from real estate professionals: marry the house, date the rate. It's a memorable mantra, right? And it directly addresses the wait for rates to drop trap. The logic here is just highly practical. If you delay your purchase waiting for rates to fall and home prices continue to rise, even modestly, the math starts working against you. Plus, the inventory that perfectly suits your needs right now might just disappear. You can always refinance a mortgage rate later if they drop, but you absolutely cannot refinance a missed opportunity on a rising home price.
Section 5. The affordability math.
Now we're shifting from the macroeconomy and focusing entirely on the micro-reality of your wallet. This is where we figure out what makes sense for you personally. When lenders talk about what you can comfortably afford, they look at PITI. That stands for principal, interest, taxes, and insurance. It is absolutely critical to understand that your monthly housing payment is not just paying back the loan. Property taxes rise with home values, and homeowners' insurance premiums, those have climbed substantially in recent years across much of the country. All of these components literally have to be part of your personal math.
So to figure out your exact standing, you need to apply the golden rules of affordability to your own income. First up, lenders typically want to see your total housing costs, your PITI, stay under roughly 28% of your gross monthly income. Second, your total debt payments, which includes this new mortgage plus any car loans, student loans, or credit cards, needs to stay under about 36 to 43%, depending on the specific loan program. So here's my advice to you directly. Apply these specific percentage rules to your own income. Sit down, do the math, and most importantly, run your numbers with a real lender. Please do not make this decision based just on the interest rate headlines you see scrolling on social media.
And that leaves us with this final, truly provocative question. Can you afford this specific home today? The data shows us a moderating market with improved inventory, historically average rates, and steadily rising prices. If you plan to stay in a home long enough to make the transaction costs worth it, and the math of your PITI fits comfortably within your budget right now, waiting actually carries a very real risk of higher prices and lost inventory. If the math doesn't work, well then no rate environment makes it the right time. Focus on your numbers, understand the market realities we've outlined in this explainer, and make the choice that builds your best financial future.